How do you decide when to sell something? Buying is easy in this business. Selling is actually much harder.
Our structures are designed so that we mostly never have to sell, right? If we don't want to. So this is one of the reasons that our kind of digital asset fund is evergreen, right? We can, for some of these assets, like say, a Bitcoin, very hard for me to ever see a moment where I say, this is done. I don't want to own this anymore. So we can hold that basically forever, and in crypto, 5 years, say, is basically forever. Like it's long enough that I don't, there's no point in trying to speculate on what's going to be happening beyond that. And then in our venture funds, these are 10-year vehicles. We have the capacity to hold for a very, very long time there. And, I think that in general, we don't really think about selling very much.
But what happens if a certain token or protocol is not getting network effects? You've got it, your core thesis is wrong. How do you get to the point where saying actually might be wrong, or do you just say, fuck it, we'll just hold it?
Yeah, I mean, we will exit if we feel like this is genuinely over. Mostly it's if we feel like we can't spend time on it anymore, right? I think that I don't want to hold things where I don't have a person on my team focused on that position and understanding what's happening in that business, in that ecosystem, whatever it might be. So I think it's mostly if we feel like something is failing to the extent that we just no longer have time to look at it, right? I think it's irresponsible to continue holding it if we're not going to be monitoring it.
No, because it's an exponential trend, so therefore it's risk-adjusted returns. If you don't see it in that term, you shouldn't be in the space, I guess.
Yes, exactly. So weathering massive volatility, even on your winning assets, is critical. I mean, a lot of that Ethereum that I bought when we launched the fund, I mean, it went from $7 to over 1,000, down to 80, now up to 4,000. I mean, it's wild, right? But my whole philosophy from the beginning is that there's so much secular growth right here. It feels like, we had this growth like of the internet, and before that personal computing, then mobile. There's so much growth here, and the whole category is compounding so quickly. The idea that you're going to be able to trade around that type of return and beat that long only buy and hold approach, to me, it's a lot of hubris to think that.
Yeah, I totally agree. This is the reason I don't look for any yield, because at 100% return, to get a 10% yield, I'm like, most of these things go up and down 10% in a day. So I don't think you get compensated for the risk in yield. So I've always kept away from yield just from that same thesis. And, I also don't trade it. I don't sell it, don't do anything in it. I just keep the position and hold it for as long as possible. I was looking at the numbers on this and just updated it last week, is that the crypto wallets and active addresses are growing at 185% a year, which is still twice the speed of the internet. So what we did is we took both the internet and crypto with 5 million users, when they both got the same age, put them on the same axis. I mean, crypto's twice the speed of adoption. We've literally never seen a technology be adopted this fast.
Every year in crypto just feels like we're in a completely different industry all over again, and the amount of shakeup there is every year in who the leading players are and everything, it's wild to me. And so being able to be patient in a category that's this fast moving, and being able to weather volatility in a category that's this volatile, I think is often a superpower, even though it in a way is the easiest thing to do. In theory, the easiest thing to do is buy and hold and be patient. The reality is a lot of market participants, I think, they can't handle the speed. They change their thesis every 6 months on what's going to happen. And they get caught, as I said, getting involved in basically trading, hedging, etc. And they're missing, they're missing the forest for the trees. To me, it's reminding investors, and then at the same time, it's setting up your fund structure, right, to mimic the asset class you're participating in, and mimic sort of the investment approach. You want to make sure that the sort of liquidity rules of the fund, match the approach and the strategy, right? So I do think, for example, with managers, it can be tempting to, make your fund really, really liquid and then your investment strategy illiquid, right? Which nobody wins in that scenario, but it can be tempting as a fund manager to go down a path like that in order to raise capital. But I think, we've been very careful about making sure our funds kind of mimic the investments.
What do you think? Do you start trying to get people to put money into this? I mean, these are the times. Now, whether it goes down another 20%, it's irrelevant, right? But this is what you look for, because this is what drives returns, is your actual entry price. That's really what's driven your return so well, is you've been really early in things and at good prices.
Yep. So we definitely try to, we try to get, more and more aggressive the worse and worse it gets. Right. I think if I've had one, again, like I don't pay that much attention to the market cycles or what the weekly price is. But, I am extremely aggressive in the depths of the bear markets. Right. And it's when everybody is doubting everything that I see the most opportunity. And it's when we've made a lot of our very best investments.
So at this point, everything's further out the risk curve, has been absolutely destroyed in price. Nobody wants it. And at that point, you're going to sift through the wreckage and see if there's anything interesting. So we're not talking about stuff that's not launched yet. You're talking about stuff that's out already. So tokens that are trading?
Really both. But especially the far out, like sci-fi tech plays are the things that get the most pain, right, in the bear markets. And that's when I like to go very aggressive in, okay, let's make the big bets right now that we know are going to take 2-3 years at least to play out. And so it's in those moments when I see a lot of opportunity to make the most risky bets.
Where do you think we are now in terms of, feels like the market structure's changed to me, but I don't really know. And again, it doesn't really matter because I don't trade it either. But what is your thought where we are now? Are you getting a sense that this is a capital deployment opportunity, or is it just a, we'll see how it goes opportunity?
The sophistication around the crypto market has improved so much over the last 2 years, right? The market makers that have gotten very serious and are in the space, the quality and reliability of all the exchange platforms, all of the institutional tooling that allows larger and larger amounts of capital to get into the space. These have all improved on an exponential curve over the last several years. At the same time, the tech development here is, it's just bigger than ever. Trying to track everything that's happening in the really kind of crypto hard tech space is near impossible at this point. The number of breakthrough papers that come out, the number of new financial protocols, new sort of like software, protocols designed for deploying applications. It's a breakneck pace, and it's only accelerating. And then in the meantime, the retail kind of hype-driven market has come off.